Welcome back to Binge Finance, and today I want to look at why Alibaba's recent record-breaking fine could actually be very good for the stock price. Alibaba is a Chinese e-commerce store similar to Amazon but bigger. They are huge, reaching nearly 800 million users with services including online shopping, cloud computing and even artificial intelligence. They control about 56% of e-commerce in China. Alibaba is definitely a growth company. Just look at the financials on Yahoo Finance here. You can see the revenue has been growing at an incredible rate, and earnings as well. And going back even further, you can just see the success of Alibaba, and there's no sign of slowing down. An article on Shares magazine reported that the 6 months to September the 30th, 2020, Alibaba's revenue grew by 32% year on year, and its adjusted earnings rose 28%. Analysts expect Alibaba's revenue and earnings to increase 38% and 32% this year respectively. And these sort of gains are not what you would find on an established large market cap company. These are the sort of gains you would find on a startup or a more speculative company. So these are phenomenal figures. But it all started to go wrong around October 2020. You can see the price went up all the way to about $320. Then something happened here, which we're going to talk about, and now the price is all the way down to $223. That's a considerable drop of 45%. So understandably, investors are thinking, is this a great time to get into this company, seeing as it's still growing at an absurd rate? Let's talk about the recent fine issued by the Chinese government and the events leading up to it. Then we'll look at the positives to come from this. Back in November 2020, Jack Ma, the flamboyant and outspoken founder of Alibaba, was about to become the richest man in China. He was due to launch his new venture, a mobile finance app called Ant Group, which would have been the biggest initial public offering, or IPO, in history. An IPO just means that the private company is taken public and listed on the stock market. But just prior to the Ant Group IPO, Jack Ma gave a speech. This speech criticised the Chinese financial system and accused the Chinese banks of operating with a, quote, pawn shop mentality. This rattled the government and they promptly blocked the Ant IPO just days before it was due to go public. Jack Ma then mysteriously disappeared and was not seen in public again for 3 months.
Good morning, George. He is very powerful, very wealthy, and generally a very public figure. But since giving this speech that was critical of China's government, Jack Ma hasn't been seen in public, and now many are questioning, where is Jack Ma?
During this time, there were rumours that he may have been detained or even killed, so shareholders of Alibaba were understandably confused and nervous. But he did eventually show his face of sorts in a video, and at the time The Guardian reported after nearly 3 months in which his whereabouts have been unknown, following a public show of dissent towards Beijing, he resurfaced last week, apparently much chastened. His 48-second appearance in a broadcast from an unknown location was like a hostage video. Alibaba remains a powerhouse of the Chinese business scene, but Ma has had his wings clipped, having taken a bold and perhaps foolish step of crossing the Communist Party of which he is a member. This, of course, drove the stock price lower, but then things got even worse. Chinese regulators launched an antitrust probe into Alibaba, saying that the internet giant had abused its dominant marketplace position for several years. As if that wasn't bad enough for the stock price, investors heard that the US SEC adopted a law which could lead to delisting of Chinese firms if they fail to comply with US auditing standards. Certain companies identified by the SEC will require auditing by the US watchdog. These companies will be required to submit certain documents to establish that they're not owned or controlled by a government entity in a foreign jurisdiction. This is because American investors have been cheated out of their money after investing in seemingly legitimate Chinese companies that are not held to the same standards as other publicly listed companies. But how has China responded? China's foreign minister spokeswoman said Beijing firmly opposes politicizing securities regulation, so we don't know how this is going to play out. And to really illustrate why the stock price fell, to make matters worse, Alibaba in particular was under examination by US State Department to potentially add it to a blacklist, making it untradeable due to its potential support for the Chinese military. That would mean no one could trade it on American brokerages. All the while, the stock price fell lower and lower, but frustratingly, investors knew that Alibaba is a powerhouse of a business and fundamentally a great buy opportunity. So, where are we now? Well, Jack Ma resurfaced after keeping a very low profile, which made everyone breathe a sigh of relief. And China's central bank governor suggested that the Ant Group IPO could get back on track if it resolves some issues. So that hopefully will be coming up in the future. But even better, and most importantly, the US State Department revealed that they would not be adding Alibaba to the blacklist. I'm just reading here from the Wall Street Journal. The US government is expected to let Americans continue to invest in the Chinese technology giants Alibaba Group Holdings, Tencent and Baidu, after weighing the firm's alleged ties to the China's military against the political economic impact of banning them. But what about the antitrust probe launched after Jack Ma gave his speech criticising the Chinese financial system? Well, yesterday we learned that Alibaba was hit by the Chinese government with a record $2.75 billion fine. I'm back on the BBC web page now, and it says regulators say that Alibaba restricted competition by stopping some sellers using other platforms. And so they've been hit with this fine, and that fine amounts to 4% of Alibaba's 2019 revenues, which isn't an insignificant amount. It's a huge fine. But this is the important part here. This penalty will be viewed as a closure to the anti-monopoly case for now by the market. And that's the key. Will it be seen as a turning point, a closure to all the bad news? They've paid the fine. Jack Ma has actually said he's accepted the fine and he will now comply. So perhaps this is a turning point. And we just learned a few days ago that Charlie Munger obviously thinks that Alibaba is now a good stock to buy. Charlie Munger is the 97-year-old partner to Warren Buffett. They head up Berkshire Hathaway. So a lot of people pay attention to them. So that's got to be good news. So the question is, should you invest? Should you buy this pullback? Well, the company is certainly strong with a 5-year annualized earnings growth rate of 29% and a sales growth rate of 47%. It's hard to find a company with more impressive track records or growth than Alibaba. But the big question is, could it get delisted? Well, a lot of people are saying no, it won't get delisted. There's an article here on Investor Place, and I've highlighted a few paragraphs to read you. In the US, regulators ultimately that's supposed to be if US regulators ultimately delist Alibaba, American investors will have 3 years to sell their Baba shares and find a broker that will allow them to buy the Hong Kong version on the Hong Kong exchange. And that sounds complicated, but I'm sure if they were delisted, a lot of the brokers would just come out with new products to allow you to buy it via the Hong Kong exchange. But the key is at the very earliest, it will take 3 years. So this is not something that's going to happen soon. And that would be 3 years starting from when they have drafted up the rules. I mean, it's still, no one really knows what's going on. So the most likely outcome could be the scenario where Alibaba simply complies to the new regulations. The company has repeatedly said that it stands behind the integrity of its accounting. Alibaba has previously been investigated by the SEC back in 2016, and there was never any bombshell revelations. So that would be the best outcome. This article summarizes by saying, in my opinion, suspicion over Chinese stock accounting is one of the biggest reasons why Alibaba shares are trading at 21.3 times forward earnings. Meanwhile, Amazon is trading at 70 times forward earnings. So again, we're seeing a potential real bargain in the stock price. But there's always extra risk when you're investing in a Chinese company, and risk-averse investors may want to wait to see if Alibaba can get back into some sort of rally, maybe wait to see if institutional buyers step back in and push the stock up. And there's no signs of that yet. Some analysts see the potential for the share price to rise this year, whilst others expect it to trade sideways. And just to finish off a Motley Fool article here, they summarise by saying, I believe Alibaba's valuation will limit its downside this year, but I also believe it will underperform Tencent, Baidu and other Chinese tech stocks, as China's antitrust regulators find new ways to rein in its dominant e-commerce and cloud businesses. Alibaba's so dominant in China, so they are the main company that the Chinese government are focused on. Therefore, it is still a decent long-term play on China's growing tech sector, but investors shouldn't expect it to generate big market-beating returns this year. So there you go. It's down to you. It's a potential great opportunity. A lot of the bad news is getting washed out now. Let's see if good news comes in, or if institutional buyers come in, and then it could be a good purchase. As always, this isn't a recommendation to buy. It's an invitation to do some more digging and find out for yourself if it's something you want to get involved in. Thank you for watching, guys. Hope you enjoyed it, and I'll see you in the next one.